You're watching the Market Comment by Haralambos Pisuros. I'm Christina Marujos, and thank you for joining us here at XM.com. The US dollar continued gaining ground against most of its major peers yesterday, but today the protagonist was the yen, which rallied following remarks by Bank of Japan Governor Ueda on exiting negative interest rates. The Bank of Japan chief said that they have several options on which interest rate to target once they end negative interest rate policy, including raising the rate applied to financial institutions' reserves or going back to targeting the overnight call rate. He also added that the speed at which interest rates will rise after exiting negative territory will depend on economic and financial conditions at the time. Ueda did not offer any clues regarding the timing of a potential exit. However, only the fact that he talked about it was enough to fuel the yen's tanks, especially amid rising expectations that other central banks will cut rates sooner than previously thought. Such diverging expectations could continue working in favor of the yen. The dollar continued to recover, ignoring another piece of data pointing to further softness in the U.S. labor market. Yesterday, the ADP report revealed that the private sector gained fewer jobs than expected in November, just the day after the JOLTS job openings for October tumbled to the lowest in more than 2.5 years. With investors still seeing a decent 65% probability for the Fed to deliver its first 25 basis points cut in March and anticipating around 125 basis points worth of reductions by December 2024, a jobs report on Friday corroborating that view could bring the dollar's recovery to a halt. Wall Street closed Wednesday in the red, with a rate-sensitive Nasdaq losing the most, even though the 10-year Treasury yield continued to fall. Perhaps some investors are done cheering the prospect of lower borrowing costs in the U.S. and may have started to wonder whether the global economy is headed for a hard landing next year. With that in mind, the stock market's reaction to Friday's employment report could clear somewhat the fog on how investors are interpreting economic landscapes. In the energy sphere, oil prices tumbled another 4% yesterday, hitting their lowest since June, after the Energy Information Administration reported that U.S. gasoline stocks rose by 5.4 million barrels last week, while exceeding the 1 million barrel forecast. The oil tumble may have been the reason why the Canadian dollar traded lower, even as the Bank of Canada maintained its tightening bias at yesterday's decision. This was the Market Comment here at XM.com.